And welcome, one and all, to the No Assembly Required podcast, a podcast where we talk about nothing and where we actually celebrate the holidays early with you, since, that's what we want to do right now. Anyway, moving along with your trio of hosts for this festive episode, starting with Audrey Firestarter Ember, and of course, your second host, the abominable Romina of the North, and your third and final host, the Grinch who stole Christmas and New Year's and Three Kings Day, Roberto Blake. Welcome to the No Assembly Required podcast, filled in front of a live YouTube audience, usually Thursdays at 8 p.m. Eastern Standard Time. We're on holiday hours right now. Please like and subscribe.
Wow. Triple threat there, Roberto. Stealing every holiday.
I'm coming for them all.
Just you're just in the they can't stop all of us vibe.
Yeah.
I mean,
what? Yeah. Before we dive too deep into everything, Audrey is wearing a very interesting headpiece. I mean, I've got the classic Santa hat.
Let's let the audience who's watching live. The audience watching live, tell us what Audrey's headpiece is in the live chat.
Yeah, guys, tell us what's going on with Audrey's head. I'm just gonna kind of describe a little bit for the listeners while people put in their guesses. She's got a headband on with a candy cane
attached to my head
type of thing. It's like a pole. It kind of looks like a candy cane, but it's a little short on the hook end.
Short?
On the hook end,
How
it's
much
a
taller?
little short.
Oh,
It's a little short.
It would hit me in the head. The thing.
All right, Audrey, why don't you describe this to us?
It's candy cane with mistletoe hanging.
Okay, so you spoiled it. All right, cool.
Wow, good job, Audrey. I was asking you to describe it. Okay, clearly you're not a writer.
We already got some guesses. Look,
we'll
said
just get that out the way.
Like I would have if you had worn that to the 368 holiday party that we went to a while back and everything like that, I would have had to go into protect mode, must protect.
Let's talk about Romina's hat for a second. Double Santa Claus
Audrey.
going on right now.
Audrey, I had enough attention in the podcast last week. I
Romina
spoke
the
for
last
40
unicorn
minutes straight.
You're a Santa unicorn.
Yeah, I'm just doing the hatception thing. But really, your thing is stealing the show right now. It's all I can look at. I feel like a fish in the water. Now I understand why fish get caught, because they see the hook, they see the little worm squirming around, and they're like, "Oh man, what is it?"
That's interesting. What's that? What's that about?
Yeah, exactly. They're like, "Oh man, it's beautiful," and then they go up to it and then they die.
Keep the viewers' retention up so that it gives their eyes something.
Oh, we trying to get that? Are we trying to get that watch time?
We're trying to keep the eyes glued to the screen.
Yeah.
All right, we about that life then.
It's just to describe it to the people who are listening. The thing about it is that she's got the mistletoe that's hanging from this pole thing, the candy cane supposedly, but it's hanging on this it's hanging on a thread, and so every time she shakes her head, it's swinging around.
Crazy.
It looks like you know what it looks like, Roberto. Oh man, it got stuck. Audrey, your mistletoe got stuck. You know what it looks like, Roberto? I
already said what I think it looks like.
All right, I know, but we're gonna. Tomorrow's Christmas Eve. Let's lighten the mood a little bit. It's got. Yes. It looks like the volleyball. When you're practicing. I don't know if that's got a name. Does it have a specific name? The pole with the ball that's attached on the string, and you can practice by yourself, or with somebody else. You know what I'm saying? Do you guys know what? All right, they're both on their phones.
Tether.
Yeah, you know what I'm talking about. The pole
tetherball.
And the ball is on the and you just
tetherball.
Play by yourself. Right, that's what it looks like. That's what it is, except with the mistletoe.
Yeah.
Caleb in the chat says that it's a weapon.
It is a weapon.
It can definitely be a weapon if you stand too close. See, that's how she lures you in, because it's a mistletoe, and you think, "Oh, I'm gonna go stand under it," and then you go do that, and then she just whacks you in the eye, and you're blind for the rest of your life.
Yes.
Andy says Romina is Santa Corn.
I like that. That's a good one.
Okay.
Right. I'll take it. I'll accept it. I'll accept
All right.
it.
So are we ready to moving to
have a serious conversation?
Yeah.
Audrey, are you ready? Because we're doing this because of you. This is because of you. This is all because of you. The entire world revolves around you tonight.
No. Please no.
Padawan, questions you have? Questions you have?
No, what?
Tonight we're going to be talking about investments, or, what to do with your money, but not really, because we're not going to be giving financial advice.
This is not financial advice. This is for entertainment purposes only. Please do your own research and do not take advice from jackals on the internet. And now we may proceed.
Disclaimer.
Specifically ones that have little poles with mistletoes hanging on their heads. Let's not take advice from those people.
Right.
But I think
Padawan, questions you have?
Last episode, I think we were going to talk about that. Audrey, do you want to kind of jump into
investing questions?
Mm-hmm.
Yes.
Yep.
I think a while ago I downloaded this app that you guys were talking about.
Mm-hmm.
What is it called? Hold on. Let me
we have multiple apps: Webull, Robinhood, Acorns, Public.
So I downloaded Acorns, and it's taking my small amount of money every month, and I don't know what's happening.
Okay, so let me explain for you and for the audience. If you're using the roundups feature of this app called Acorns, you connect all of your debit cards and credit cards, to it. So let's say Audrey, you go to Starbucks and you buy something and it's like $3.50. Acorns uses something called the roundup system. So instead of you just paying the $3.50 for your coffee, you will be paying $4. The 50 cents difference will be invested for you through their robot advisor. And that will go into what is referred to as an index fund. Now, this is the safest way to invest money. The way index funds work they are a bundle of stocks. Index funds are bundles of stocks, usually from the S&P 500, the 500 most profitable companies in terms of their market cap valuation in the world. So you know how like Apple, Google, Microsoft, and Amazon are worth like all over $1 trillion? They're the leaders of the S&P 500. They carry the S&P 500. You're also going to get the other not great performers in the S&P 500. The wins of the big guys balance out the losses of the little guys. And if the little guys or middle guys are winning and the big guys are losing, it all kind of balances out. On average, conservatively, over a 20-year period, the S&P 500 tends to do somewhere between a 12 and 16% return over a 20-year period, conservatively in that range. Okay. So it's a safe bet that if you put your money in the S&P 500 over a long period of time, you will gain some money and compound interest year after year after year after year. You won't lose money. You might in one downturn 1 year, but you'll make it all back up the following year, and so on and so forth. And on average, over the course of like 10, 20, 30 years, you'll always have an annual return of about roughly somewhere between like we said, somewhere between 12 and 16% on average. Okay. Here is the downside. If you, for example, buy individual stocks, some people consider that gambling. But if you buy individual stocks definitely tend to perform better than the average of the S&P 500. So that means that they quote unquote beat the market because they beat the average. You with me so far?
Yeah.
So if you put $500 into an index fund at best, at the end of the year, maybe that $500 is $520, $550, $560. And maybe because you were in a few companies that pay out dividends, so they're companies that are so profitable that they give their shareholders a little chunk of change for every share that they have, you might make a couple of pennies on the dividends. Maybe you make an extra $3 or $4 here. Okay. Now, by comparison, if you take that same $500, and I already did this experiment for everybody in one of my portfolios in M1 Finance, I did an experiment. I picked the top 4 companies by value price in the S&P 500, which were Google, Amazon, Apple, and Microsoft, all worth $1 trillion. So I picked the tech Illuminati. I put $500 in, and now my investment is worth $730. So I did a substantial return, much more than I would have if I'd put that $500 anywhere else by splitting it among these companies. Now, if I'd went all in on Apple, my return after 1 year on Apple was a 99% return. And just a quick peek for the audience so that they know I'm not full of it, I'll show you. And none of this is a humble brag. This is just my M1 portfolio. On one portfolio, I put in 500. On another one, I put in like 1,500 or 1,000. And my average total return across this entire portfolio was about 39%, which is much more than the average would normally be. So I got almost 40% return on that money that I put in. So basically, you could say it's like I put in like 2,000 and I got 500 out of it. So I did relatively well, right?
I think it's just to kind of put this in perspective. When you put your money in a bank account, inflation, you get like you get 0.00001% return. Just to kind of put that in perspective. Yeah. So I do want to kind of call out Caleb in the chat, because he kind of brought up something that I think is a concern for a lot of people, at least first time investors, which is, honestly, I'm scared of putting stocks in any companies right now. With the recent national troubles, I expect our economy to dip eventually. So here's the beauty about stocks, is that they go up and down all of the time. Yes. All of the time. And yes, they do go down, and sometimes they do crash, and sometimes really bad things happen. But on the flip side, there's more good things that happen than bad things.
In fact, in this economic downturn, you might have seen a bunch of headlines and articles that the biggest companies in the world and the wealthy all got rich during the pandemic. Now, I understand why that makes people uncomfortable, but you could look at it another way. The benefit to people who didn't lose their jobs or anything like that is most people's pensions are tied in the S&P 500. So your parents' retirement, your grandparents' retirement, your retirement or 401k, if you are still working and you're investing in your 401k, your retirement, your parents' retirement and pension, and your grandparents' retirement and pension are all tied to the stock market. Nobody should be rooting for the stock market to fail just because of their own bad circumstances, because that's bad for the entire country. And it's bad for people you know and love that are looking to retire or looking forward to their retirement income or have a retirement income. It is actually very bad for people you know and love. So you shouldn't spite people you know and love. You shouldn't spite people you know and love who need that money just because you think that it going down would actually hurt a lot of millionaires and billionaires that, frankly, even if they lost all their stocks, would sell 4 of their 8 homes and still be richer than you.
That's really something else that I wanted to bring up too, is Caleb mentioned the national troubles, but stocks are not exclusive to any one nation. The stocks is something that is international. And you can invest in companies outside of your country as well. And that's something that can help you to diversify your portfolio so that when your nation is going through some kind of economic crisis, another nation is doing well. So you are doing okay. And then on top of that, what Roberto was talking about is a lot of people don't realize that the stock market is tied to pretty much even just having your money in Chase, you are in the stock market. The only problem is that you don't get to see the kind of returns that you see if you actually go directly to the market and invest your money there.
Yes.
But any banks, anytime that you put your money into banks, 401ks, any kind of retirement, all of that, your IRAs, everything is tied to the stock market. And when you have, like when you go to a savings account, that is also stock market. Like I'm talking an actual savings account, not like a high yield savings account, not
just the regular one that the banks offer, the one that your local bank, your Bank of America, your Chase, your Citibank, the one that they offer.
It doesn't actually change the
concern. Here's what I'll change Caleb's concern. He says, bring this up, Romina. If I recall, there was a span of a month earlier this year when the stock market went down for 25%. That was pretty scary. It's pretty scary if you need that money, which is why the rule of investing is you don't put money in that you need or that you want or that you're like not willing to risk in terms of risk and reward. So that's part of it. And also a disciplined investor for all those people who had money that sold when it went down 25%. Lost when it went back up another 20 from where it was. So the thing is, Caleb, here's if you're this is not financial advice. Here's my plan and here's what I do. This is not telling you how to pick your stocks. Here's what I do.
This is Roberto talking about his experience and what he does.
And you saw this in my portfolio. I pick companies that have 5 to 10 years of nothing but growth. And that's it. I only invest, with rare exceptions, in companies that only have 5 to 10 years of growth, because that's not gambling. That's called an obvious pattern. That's called picking a proven winner. And that's called betting on somebody. That's called betting on a gladiator to keep slaying rookies. If you believe the rhetoric and the hype around monopolies, and you also believe that there's no way in hell that any legislation will actually address this, and nobody with any teeth in politics. And the only reason I really follow politics is for the economy. Is if you believe that, one, these people aren't all invested in the stock market and are going to enrich themselves and are only going to pass legislation that enriches themselves. If you don't understand that that's the case, then because there's actually no laws stopping them from using their position to enrich themselves. So that's number one. And actually, for any public disclosures of what our Congress people and senators are investing in, I take a look at what they're invested in and I go take notes. So because I know they're going to rig the game for themselves. But what I also know is that there is no stopping a company that's already worth $1 trillion. There's a such thing as momentum. There's a such thing as inertia. There's very little chance that 10, 20, 15 years of a company being successful is going to reverse itself if it is an innovative company and if it has a long track record of success. Very few companies end up like Kodak, and Kodak only became Kodak and became a punchline because it didn't champion innovation and it didn't go to digital. It held on to the past. Blockbuster went under for the same reason, so it'd be smart to bet on their competitors. Netflix, for example, Sony, Fuji, on and on and on. So what I do is, if I don't want to lose money, I invest in companies that I know have been around for a long time and that I believe in my heart of hearts will not be gone or diminished in value in 10 years. And I look at the previous 10 years. There's no reason to think that Apple will be less profitable. If anything, I would say there is no chance in hell that Apple is ever cheaper to buy than it is right now. There's no way in hell. And my biggest regret in life is not buying Apple 10 years ago, because I would be rich.
Right. And then the thing is so when you are in stocks, there's a lot of, you have to use your instincts, your intuition, but above all things, research. That's really what it comes down to, is doing the research and looking at the data and being able to analyze the data. So there's obviously different ways that you can invest. And some of them are riskier than others. I myself like to diversify. So like Roberto, I also invest in stuff that has proven to have a growth pattern and to have been successful. I'm invested in companies that have been around for 30, 40 years and more. And so obviously they're doing something right. If they're still around and they're employing hundreds of thousands of people, they're doing something right.
There's no downside to investing in Walmart. It's the second largest employer in America. If Walmart goes under, America is doomed. So that's a good indicator.
But see, on top of that, you're investing in places that you know have some kind of history. But then on top of that, I also invest in stuff that's a little bit riskier, but stuff that I believe in. It's kind of like ARK investing, which is investing in companies that are innovating, companies that are doing something a little bit different.
Tesla.
Right, exactly. Tesla's a really great example of that. And Tesla is now in the S&P 500. So that's kind of like a testament of like, okay, sometimes it's good to take those risks. But again, like Roberto said earlier, you have to look at your own finances. And if you can't have money that's just there if you need to touch that money, then you're not ready. Then you're not ready.
Which is why the best way to start investing is, in my opinion, and my experience is there's a couple of things you can do in terms of spending your loose change, like we talked about for Audrey, just to get a sample for it and to also then start to study. Because what I started doing is, and you guys know this, is I didn't invest until I was in my 30s. I didn't invest until I was in my 30s. And I started with Acorns with my loose change, and it added up to like a substantial amount of money, as you know. I then pulled it out and I pulled a lot of it out. I left some in, and I invested in individual stocks based on my understanding of how they performed in my index fund portfolio. So Audrey, for example, remember how I told you like every 50 cents, if you spend like 350 would go into the S&P 500 into a very safe index fund that's a group of stocks? Well, I looked at which of those groups of stocks had the most growth and the most potential. And I researched all those companies. And I looked at their financials and said, oh, they've been growing for the last 5, 10, or 15 years. And oh, these are companies I all know. So here are the ones who are winning. Well, what lost? And so what was I buying? What were they investing in? And so I looked at these portfolios and I picked the winners out of these portfolios and said, I'm going to individually invest money in these things. And I'm going to pick and choose how much and where goes where. Because when you use a robo-advisor, it's picked for you. So again, you can play there. This lets you have some safety by having your spare change always invested in the market so that every time you spend, whether you know it or not, you're automating investing. So that's one of the first things I did. As you guys know, the second thing I did was I decided to also put a recurring Acorns investment in place. Now, what I recently did in the last year or two was I decided that I would have one of my Acorns recurring investments go to a retirement account. So it would be something that's tax advantage and puts away for my future. And in my case, because I'm a small business owner, it's one of my SEP IRAs, which is a simple, God, what is it? I think it's called a simple employment pension or something like that. But basically, I'm a small business owner. And the reason I did that was because I can put more in that every year than I can put in a traditional or a Roth IRA. The most people, you have a traditional Roth IRA, you can only put $6,000 a year in that, which means the most you can do is, if you average it by month, is $500 a month. Now, that sounds like a lot of money, but I want to remind you all that what we're talking about is roughly $18 a day extra. So if you go and you do gigs on Fiverr, you freelance, you do something on the weekend, you find a few ways to make like $150, $200 a week extra somehow, some way in your free time, you can max out your Roth IRA every year. And this is something that's essential for your future. If you want to retire and you don't want to work until the day you die, you can do this, and it's really smart to do. And it's tax advantages to doing either a traditional or a Roth. You can either lower your taxable income with a traditional IRA right now, since that won't be counted against your income, or you could pay some taxes on your Roth IRA stuff now, but when you retire and you need that money in your old age, when it might be worth more, you won't be taxed on it at all, and it'll be a larger amount of money because of compound interest over the years. So You just have to decide where you are age-wise in life and whether you want tax advantages now or when you retire. Now, because I have multiple tax accounts, but I'm also in a higher income bracket, so grain of salt here. If I wasn't, I would prioritize, in my opinion, I'd prioritize my Roth IRA because I'd be thinking a lot about my future. And there's a cap limit to how much I can put in the Roth. And I would get another account outside the Roth. You can't have a Roth and traditional. You can only, or you could, but you can only donate between the two, $6,000. So like, I wouldn't split the difference on that. I would have another thing. Like if you know you're going to max out your Roth, let's say you have a good paying job and you know you can max out your Roth. You have your Roth independently that you put in, and then you take maybe the company plan on a 401k, or you get a solo 401k that you control the investment in instead of the company investing for you. Because if you go with your company, sometimes they'll invest, they'll put your retirement into shares of the company like Enron did, and then you're screwed. So I would say get a solo 401k, in my opinion, just what I would do. And also if you're a small business owner, you can have a solo 401k, and you can have a SEP, and you can have a Roth. And if your business qualifies, you can have a health care savings account. Now, if you're a small business owner and you make enough money, I don't yet, but if you make enough money, that would mean your maximum tax advantage accounts. This is not all tax deferred, but your maximum tax advantage accounts. Talk to your CPA, talk to your accountant. You could probably save about roughly theoretically $100,000 a year that would theoretically be put toward your own retirement, rather than being your taxable income to the federal government. And you want to pay the lowest legal amount of tax allowed, and you want to invest in your future or have that money go to your children, your spouse, your significant other, if anyone happens to you. So you want to always have a beneficiary on the account, so the money goes to somebody instead of going to the state, because depending on where you live, the state and federal government will divvy up your assets when you die if you don't have a will or a beneficiary. So it's really good to make sure you have a beneficiary on all of your bank accounts. All of your investment portfolios have a beneficiary, husband, wife, son, daughter, niece, nephew, friend, somebody who can collect that money, because otherwise it will go to the government. And have fun with how they spend it. But the So there's I'll break it down further later. But
what are some of your favorite books about this stuff? Because I feel like I need to.
Oh man, well there's a okay. I'm gonna recommend one right now. Money Master the Game. By Tony Robbins. I would say that is probably one of the most comprehensive guides to investing. It's a textbook. I mean, it's not really a one-time read. It's definitely one that you might want to read multiple times.
Caleb, easy money exists for smart people.
Right.
Caleb,
I just wanted to say stuff about that because I was looking at that because I feel like So Caleb said it's very difficult to find significant and risk-free company, but we literally just told you how to do it.
All right.
We just spent like 15 minutes telling you how to do it, which is the natural research. Financial. I mean, it really is just looking at money, whatever the history is of those companies, because and we can't tell you, like Roberto used Walmart as an example, but we can't tell you what those companies are. You have to do the research.
You have to do the research. I mean,
it depends on what you feel comfortable investing into.
Yeah, I can tell you, and I will just tell you the 4 companies that I've never lost money on. And this is not telling you to invest in these. I get stock tips from people and it does very well for me. I made money just this week. I made without any effort on my part beyond what I already make in passive income from the internet, because I'm an investor. And don't hate on me for this, because I know people have a bad economic situation, because I'm actually trying to help you. And I'm actually learning this stuff and I'm sharing it. I'm even about to start in 2021. I'm going to be blogging a lot. I may not always make YouTube videos about it, but I'm going to be blogging about this stuff because I was financially ignorant for most of my adult life. And I was still smarter than most of my friends about money. And yet I did not have the tools in my arsenal intellectually at that time to build wealth, because I didn't understand this. And on a long enough timeline, this just works. And I understand it. And I'm not saying you said something wrong, Caleb. I'm saying you're saying something fearful that I said. And that fearful mentality that I had that was just like yours, it kept me poor. Because I will tell you this, Romina, I graduated from high school in 2002, as you know. And at the time, I was working at the mall. I was working at Hex, which would become Macy's. I was selling shoes like Al Bundy. And I'll tell you, I was a college student. I was working my way through community college. I'll tell you what, if I had taken one of my weekly paychecks at the time, which was about roughly, because I was making some commissions on my sales, because I was a really good salesperson, I was making like $350 a week or something, right? Not a lot of money, even back then. $350 a week. Or it might have been less than that, but I think those were good commission days. But like it was $350 a week. I did some math, and if I had taken for what the valuation of Apple stock was back then, and it's not like I didn't know who Apple was. I was going to school for graphic design. I knew who Steve Jobs was. I knew about Apple. This is 2002. If I had bought $350, just one week of my pay, if I had bought $350 of Apple stock back then, between the stock prices and the stock split that happened now,
right,
I'd be fucking rich.
Right.
I'd be like, I would literally be a millionaire because of the value, because of compound interest over time, for one thing, the valuation of the stock. I did the math and I was like, I wanted to cry that 1 week of my lowest earned income tier at like 17 years old, today at 36 years old, would have made me wealthy over the last 18 years, just because of how compound interest works and just because of what Apple has done as a company. And it wouldn't have been some big, absurd gamble. It's why there are people who bet early on Tesla with just like $10,000. I say just, but for them, it was like their whole life savings. And they're millionaires now.
And now they're millionaires.
Because they took a risk.
That's the thing. So here's the thing. If you had taken that risk, you would have cut off years of time that you spent working
and struggling and every number of hardship. So, my family, like
I just want to rewind a second, because I think maybe Caleb said that because of my tone.
Yeah.
I think I scared Caleb. I didn't mean to, Caleb. I'm sorry. You should definitely just rewatch this live stream after we get off and just take notes, because I feel like it's a little bit easier for Roberto and I to talk about this kind of stuff. And I think Audrey is easy for her to follow, because Roberto and I kind of talk about this kind of stuff like every other day in front of her. So she's used to the language. And so I feel like she's just kind of, it's easier for her to keep
Speaking of language, I have a book for Caleb and anybody else out there. The best book on personal finance for the average Joe or Jill is Rich Bitch by Nicole Lapin. She uses very colorful language. She's the female Gary Vee. Just understand that. The entire book is F-bombs, so that might hurt your sensibilities. But it's the best common sense thing, because Nicole Lapin didn't have a debit card.
What are you going to expect?
Well, Nicole Lapin didn't even have a debit card until she was like 25 years old. She was like old school cash and broke, and like, oh, can I pay at the restaurant with a check? Like, embarrassed in front of her friends. And she ended up dating a finance bro that made her, that she ended up breaking up with, that made her feel insecure and feel stupid about money. And that made her decide to become super smart and incentivized her to like show that guy up and never be shamed by a man again about
money. You know how many people go through stuff like that and they revert to victimhood?
Yep, exactly.
And it's like, oh, I feel like I'm stupid and this is just, I don't want to play the game. It's like, no, you either play the game and you win, or you don't play at all and you lose. It's like, I mean, like there's really no other way to do it. But I feel like I want to go back to kind of, you were talking about your method of getting started. And I just want to say, because like, I feel like Roberto and I, when we started investing, we started investing at kind of different stages of our lives.
Yes.
And so I feel like I started investing when I was still in debt, and I still had a little bit, I still was not quite on my feet. But I had the intuition and I wanted to take the risk. And so my steps towards doing that was, I actually started with a high yield savings account. So that was my first my first trip into investing. And so I found the highest bank that would offer me the highest yield for my savings account, which at the time was something like 3%, which is now unheard of. Now, of course, because of everything, it's like 0.30.
1.7. It's 1.7 if you go with like Marcus or Goldman Sachs.
Right. Well, no, Marcus right now is 0.50.
Really? Oh, then Ally Bank, I think, still is.
But I mean, there's no point. I was trying to chase those, but it's no point with that percentage. I'd rather just go to the stock market. But I started off with a savings account, and just started to add money into that savings account. And again, mind you, like I really couldn't just do, $20 a day or $500. Like that was not a thing. That was how much I was making total. Right. So it was just like, I could not invest more than that. And I really started by saving $5 every month. And the first year of doing that felt like I was literally just putting as much as I could while I was paying down the last bit of debt that I had. And that first year was so hard because I was like, I'm putting away $5. It feels like I'm not getting anywhere. Like, people are talking about putting $5,000 down. And I'm just like, I'm here with like my stupid $5. Like, this is retarded. Like, it's dumb. I hate this. And I finally, when I got to this point where I was like, wow, I am actually saving up money. And I looked at my bank account and I saw like the number increasing and the digits getting longer. And I was like, wow, this actually makes a difference. On top of the fact that I'm putting in money, I also had compound. So I was building wealth for myself. And it all started with $5 a month, which was something that was doable for me. Right. And then after that, I started to venture into the stock market, which was buying a couple stocks here and there. And that was very experimental for me. It was very much of like, hey, how much can I afford? Oh, $30. Like, let me find what stocks I can buy for $30 and which ones should I buy? And it's taking the risk of like, okay, I'm learning as I go along, and I'm obviously not going to put down $10,000 because I don't have the money, but I'm learning as I go along. And in doing this, I ended up with some stocks, which I was able to sell this year and had extremely high returns because of that. And these are stocks that I bought.
So you were able to liquidate.
I first started. Exactly. And so as far as getting started, it really is just taking those small amounts and adding them up over time, plus the compound. And and I think because Audrey was kind of talking about the apps that she was using and stuff, and I think some people.
I'll circle back to that.
Someone in the chat mentioned something about the apps. I don't know who, but
they want some safe apps, and I'll explain what safety is and isn't, and what risk is and isn't in a bit. I'll let you finish though.
Yeah. So I was just gonna say, I mean, there's a number of apps and platforms and brokerages that you can go to your bank. Exactly. It's really, again, I don't think that we will go like super deep into each platform, but
I'll just tell you what I do.
Yeah, there's a lot of different platforms, and they each have their own, like some of them have fees, some of them don't, some of them have higher percent. Like it's pretty different, like from one platform to the other. So it's just kind of looking at whichever is the right one for you. I myself have used 3 of the different like popular ones.
I have
Robinhood, M1 Finance. I signed up for Webull.
Yep, Robinhood, M1 Finance, Webull, Acorns, which is a different type of thing.
I never used Acorns because I was just doing it manually myself. So like when I heard about Acorns, I was like, I'm already doing this. I don't need an app to do it for me. And then
Public. I use Public.
I also have Vanguard as well.
I have Vanguard. I don't put a lot in it, or I don't really do anything with it. I have it to have it. I'm going to use it for something specific later because there's some stocks that are easier to get into, but they have a higher buy-in, like Betalix, and there's a whole thing there. Anyway, I also do Fundrise now. I'm doing an experiment with Fundrise. I put in some money because I want to experiment with that to see if it how it is on the REITs versus doing it manually. Because I'm gonna make a video about it. But here's something to understand. I'm gonna tell 2 stories that are anecdotal that kind of will help people with perspective. I was able to take money that I made from my investing primarily. Well, money I made because I invested in myself, built up my business and my brand, made myself have disposable income that I could put into the market. I was very successful in some of my investments and my trades. And as a result, I was able this year, even with all this stuff with COVID, it was one of the proudest days of my life. I didn't make clickbait video of and I'm not accusing anybody of anything because it's a really smart strategy and it's really good. But I didn't make a clickbait video out of it. But Romina, you and Audrey both know this story. I gave my mom $10,000 and cleared most of her debt and put her in a good position and able to have some significant savings of her own again. And it was one of the proudest moments of my life. One of the proudest moments of my life is that I was able to do that for her without it really being any kind of inconvenience or hardship to me. And I wouldn't be able to have done that if I wasn't able to smartly invest in myself and build my business. I built my brand in my business and became a freelancer and then became the person you guys all know today when I had nothing. Practically during the last recession or right on the tail end of it. I left the job that people would say, especially at that time, was a good job in a low, in North Carolina is cheap cost of living. So for relative to where I was, it was a good job with a good salary. And I left for moral reasons, irreconcilable differences. I left without a backup plan or another job lined up or anything. It was one of the best paying gigs in my small town. And I went on my own. And all I had to invest in myself with my plan and everything, and I'd been building up the resources, was I built my business with a $400 laptop and a camera that today is probably $250 retail. At the time, I think it was $650. I built everything that you see me with today. And I got to 100,000 subscribers on YouTube over the course of 3 years, by the way, with about $1,500 worth of stuff, which was relative to, I didn't go out, by the way, and just buy all this stuff and start a YouTube channel. I did it incrementally even before I did that. I'm saying this is the cost of the resources I had. The cost of the resources I had by the time I left my job was spending and saving up before I even left, because I had been planning to leave my job for over a year before I actually left. And I built everything that you see today with the beginnings of $1,500 of stuff that I bought over a period of time. A cheap camera, the kit lens on the camera at the time, and some cheap lights, and a $400 laptop that would burn my legs whenever I didn't set it on the table. And I built, and my YouTube channel, I still had that camera all the way up to 100,000 subscribers. I didn't upgrade to my G7 and then later my other cameras well until afterward. That's it. So I invested in myself. And over a period of time, that worked. I naively kept holding on to cash that I could have and should have invested in the stock market and grown over time. But when I didn't hold on to cash, I was investing back in myself over and over and over and over and over again. In fact, the first 3 years I did YouTube, because people, oh, you were a big YouTuber. The first 3 years I did YouTube, one, there wasn't almost any AdSense money because I was a small YouTuber. And then when I did get to 100,000 subscribers, what a lot of people don't know, and I keep saying it, is I was in a multi-channel network contract, Romina, you know this. They were taking 50% of my ad revenue on top of the 45% that YouTube already takes. They were taking another 50% of what was left over. So,
what a steal.
Because when I was a small YouTuber, all the big YouTubers were signed with networks and they promoted it. And that's the way it was. And nobody educated me. You know what? Part of why I ended up becoming a YouTube educator? Because of all the mistakes I made, because no one talked openly and honestly about YouTube. And one of the big money mistakes, and the reasons I'm transparent about money, is a company took 50% of my YouTube earnings that they did nothing to help me grow, didn't keep any of their promises to me. And in fact, when I finally did break my relationship with that company, and you guys know this, I've tweeted about it, they still had owed me $4,000, which they're still paying off. When I left, they owed me $4,000. So they like literally stole from me. They literally stole from me. And I got nothing out of that relationship except for lessons. I got nothing out of that relationship except for lessons.
That's true.
So I'm saying all of that. I'm saying all of that to say that my investment in my 20s was in myself and in becoming as educated in my craft as possible and in my tools of my trade. And then when I used that and I worked my way out of debt and all that stuff, and I built up my business, I was holding cash that I wasn't using to grow. And I started investing into the stock market. And one of the lessons and one of the things that put me in a position to do was I was able to give my mom $10,000. And that's something I don't think I would have been able to do otherwise. And without it, hurting me a little bit. And then the other thing is, I have a good friend that I've known for about 4 or 5 years now. I think Audrey and Romina know who this is. I'm not going to name him, but he's a fairly successful content creator. He's going to hit 1 million soon, I think. He's really up there in his niche. I've known him since he had like 150,000 subscribers or something like that. And I gave him some YouTube advice that really helped him. And I didn't just help him grow his channel. We stayed in touch. And I actually started teaching him about how he should invest his YouTube money in the long term, because we became really good friends. So I gave him personal advice. And he had a story, and he opened up to me about how once upon a time he used to be homeless, and that his deepest fear is that one day the channel wouldn't work anymore and he'd end up being homeless. And I said, well, you should put all of your money and all of your energy into saving up for a down payment on a house. And then you should put all of your effort into paying down your house and paying on principal and not waiting 15 years for something to go wrong. And you should do that. And the thing is, we talked, and within 2 years, he owned his house, which at the time was a $400,000 house, because I taught him a lot more about YouTube business. I talked to him about how to do more than AdSense, to go outside of brand. And I taught him how to negotiate brand deals, something I talked to both of you about, something we talk about on the channel. And I did everything to help him grow his business beyond YouTube ad revenue and to really get the most out of brand deals and to do other things. And it really helped him make all the extra money. And then instead of spending his money, which a lot of his friends did, a lot of his friends were younger than him. So his friends went out and bought cars. They went out and they spent money on bottle service and everything like that. They got into relationships with people who took advantage of them. And he took my advice and he lived like a monk. He took my advice and he lived like a monk and worked hard and grinded and put all of his money into a single goal. I will never be homeless again. And he ended up owning his house outright, $400,000 cash. And then he had this disposable income from his channel. He's like, well, I'm sitting on all this money. What do I do now? And so I was like, well, have you ever invested before? Have you ever, done this? Have you ever done that? And so we talked. I gave him some advice and I told him some of the things I'm looking at. And we've been talking and we were very open to each other about money ever since. This has been many, many years. And today he is right about at the cusp where he's about to be a millionaire. If you count the value of his house, which did go up. So his house is worth over 500,000 now. So that's like a good chunk of it. And because he was doing very well with his YouTube channel and his money, and he invested properly, he made, even this year, in terms of extra money in just one of his portfolios, he made an extra $22,000 in just one of his portfolios for no reason, that's like a salary that he made without labor because of leverage, because that's how investing works. So when I told him, hey, you have the house now, so you're never worried about being homeless. Now your fear is just not having enough and not being safe. And well, what if you can't do YouTube anymore? Because he was having some health problems, and also some of his money was being because he has a chronic illness. So and he has treatments, and So his money was being eaten up by his medical expenses. So don't think he had some easy life or anything like that. This is somebody who overcame.
Right. He had challenges and that he had to overcome. He had obstacles.
Exactly. So even with all that money, it can't always buy health because he has the access to the best healthcare, but it doesn't. It's not enough sometimes.
Right. It's not going to cure. Yeah. Sometimes there's no cure.
But he's gotten better treatments as a result of it and going through a lot of these things. And so he's in less pain than he's been. He's in less pain today than he's ever been in like 8 years.
And not just the physical, but also the mental
and the emotional.
Relief. Yeah, exactly. I just want to kind of switch things over a bit because we've kind of been talking a lot.
Sure.
I want to flip the tables a little bit. I would like Audrey to give us her 2 cents.
Or ask any questions.
Give us your 2 cents.
Well, I don't know if you guys finished your book recommendation list.
All right.
I only have
Roberto
2 more.
Had 3.
So I only have 2 more. I have Rich Bitch by Nicole, Lapin, and it's great as an audiobook. I recommend everyone get it as an audiobook. You go to robertoblake.com/audible and get 2 free audiobooks, I think. I think that's still the deal. It's an affiliate link. But Rich Bitch by Nicole Lapin, I Will Teach You to Be Rich by Ramit Sethi, and of course Dave Ramsey's Total Money Makeover are the 3. You might think that some of their advice is contradictory, but you can literally just have it all ways. The thing I disagree with Dave Ramsey about is credit. He's anti-credit. I'm like, credit good, debt bad. I'm anti-debt. Yeah. Dave Ramsey is anti-debt, anti-credit. He's anti a lot of things. He's a grumpy old man, but he's smart about some things. I just think that he's wrong about credit because I think he would agree.
I think it's all about learning how to use your credit. It's all about learning.
The third one?
I'm a
Money Makeover.
I'm a fan of credit now.
Total Money Makeover. I Will Teach You to Be Rich by Ramit Sethi, and then Rich Bitch by Nicole Lapin.
Okay. Did you get that?
Yes.
So yeah. So access anything.
So what are your plans, Audrey? What are you thinking about right now? What have you been looking at? What's your research you've been doing on your end?
I was confused about what was happening with Acorns because I kind of signed up and then let it go.
Are you less confused now?
Yes. I think I'm gonna keep that going for now and then maybe read about it a little bit more because some of these words still like index funds and all that still a little
let me ask me any terminology that confuses you and I will give you the shortest definition.
Index funds.
Index funds is just a pool.
Bundle of stocks.
Yeah.
It's a bundle of stocks. And the thing is, when you go into Acorns, it tells you 4 different types of investors, and it gives you a pie chart. And your money will go into different types of funds depending on your investor type. Since I'm a moderately aggressive investor, more of my money goes into stocks that are companies that are big, medium, and small. And that puts some of my money into real estate, trust, and into savings bonds with the government and such. So it splits up and diversifies it much more. If you went really aggressive, like most of it would be stocks, like 70% of it would be stocks instead of like 50 or 60% of it. You see what I'm saying? So that's what the different pies are and the investor types. Let's say you had $1,000 that you were like, okay, I want to invest this. If you put that money into Acorns, what would happen is some of it would go into a bundle of stocks that might be your Microsofts, your Apples, and some of that. And then some of it might go into stocks for things you never heard of that are overseas companies or new companies that come out, startups and things like that. And then some of it will go into safe things like real estate development or into government savings bonds. Okay. But you'll see the percentages and you could kind of technically see where some of these are, but maybe not what individual companies, how much shares you have of individual companies, not all the time. Right. So it's investing for you. You don't have choices. So that's Acorns robo investing. And again, index funds are just a bundle of stocks. It's a big group of stocks. And when you put money in, like you're betting kind of on all of them and it's spread.
So it's kind of like it's for example, it's like I could start an index fund, right? Like I could have a company that believes in clean energy and all of the companies that we invest in have to do with that kind of thing. Green companies, right?
Yep.
So you could come up to me and you could be like, here, I'm going to invest in Romina's index fund so that it could just I do the research, the index fund does the research, and they decide where all of the money gets distributed to all of these different companies.
Let me translate this to YouTube terms. Let's say we could invest in YouTubers. I could create like the Tech 500. And the thing is, if you invest in the Tech 500, sure, some of your money will be invested in iJustine or Marquez or Jonathan Morrison, but some of it also might be invested in smaller creators like Viper or Travis or Greg or any number of people we know. Tech Me Out, Total Tech Geek. You might end up with those. So the thing is, your top performers will do very well, but that'll be averaged against your smaller stuff and whether they perform or not too. So that is just kind of an analogy for investing. You can think of the market cap on companies, like when we talk about big companies like Apple and everything like that, you can think of Apple and Microsoft and Google as like Marquez and Lou and iJustine and Jedner, right? Yeah. And then these small cap companies would be the YouTubers that are like under 10,000.
Yeah, that makes sense. I don't know if right now, maybe like what Romina was saying with the, wait, okay, that's another question. When Romina was talking about the like savings account, I'm kind of confused as to how that
if you leave your money in a regular checking account or even a regular savings account that doesn't usually have any kind of real interest or whatever, here's the thing. There's this thing in the world called inflation. Inflation is where over a period of time, your money becomes less value because the cost of living keeps going up and up and up.
Because they keep printing money.
But there are market shifts and things that happen because if money, regardless of if they print money, if more money is circulated and the economy is booming, it'll sometimes cancel that out, but I digress. But the point is, money is usually worth less over time. That's why you'll hear old folks like us say, back in my day, you could fill up a gas tank for $10. Back in my day, candy bars used to cost 65 cents. Now they're $1. You'll hear that. So the value of money depreciates over time. It becomes worth less and less over time. Assets, however, and assets could be your stocks or real estate or other property that you own, they might appreciate over time, which means they might gain more value over time. For example, if you buy a classic car or something that's from a classic car line, if you take good care of the car, it might go up in value over time. If you take care of your camera lens, it may not go up in value over time, but it may not lose value if you take really good care of it. A camera lens you buy from Sony for $2,000, 2 years from now might be still worth $2,000 or pretty much close to it. You see? So, but a camera body will depreciate rapidly over time, whereas a camera lens will not. So the thing is, camera lens is a much more stable asset. So think of it the same way. Cars are usually a sunk cost. They become less valuable from the day you buy them. So buying a used car is great because it's already lost most of the value it's going to lose within 3 or 5 years. So if you get a really good car that's 3 or 5 years old and you take good care of it, you got a deal because you didn't buy it at that new car price where it's going to lose like a good chunk of its value, 40% of its value, like in 5 years, So you're getting it at a good price.
I think, wait, hold on. But let's go back to the savings account thing, because I feel like,
I was explaining assets, but yeah.
Can you ask specifically, what is it that's confusing you about the savings account? Like, is it that you don't understand how it works, or is it that you don't understand
I know how savings account works. I was just confused to how you were like investing money through your.
All right, so Ramit,
so here's the thing. So there's like there's a savings account, like when you go to Chase or Wells Fargo or like, one of the big ones, right? The ones that you see down the street. When you go to one of those banks, you can open up a savings account and you can open up a checking account. Yeah. And your savings account there, you're going to be earning interest on most of those accounts that you can open at those banks, but they're very, very, very low.
Like not even 1%.
Right. It's like 0.0001% of what you're going to be earning. Basically, you're going to be earning like a quarter of a quarter of a quarter of a cent for like every dollar you put in there.
And since every year inflation averages about 2%, you're technically, while the dollar amount might be the same, your money is worth less than it was when you started just by holding cash, whether it's in the bank or whether it's under your mattress.
So here's the thing. When you are looking for an actual savings account, you want to go outside of those banks and you want to look for high yield savings account. Those high yield savings accounts are able to give you a higher percentage return every year. So depending on how much money you have in there, you could be making residual income off of the interest that you earn from just having your money in there.
Which neutralizes the value of your money going down due to inflation because you have proportionately more of that money.
Right. So easily, like you could be getting, $20 a month, right?
Just smaller banks that are doing this or something as an incentive or
what? No. So this is just how it works. It's just because the interest rate, it's a little bit more complicated to get into than like this podcast, but the interest rates have gone, it works with the Federal Reserve. And so because of that, we have much lower interest rates now because the money is being used in other places right now. So it's a little bit complicated about with the interest rates. It's not something special that like banks are doing right now. It's something that's been going on forever. And it's just a place where people can put their money. And instead of just going to a traditional, the reason that some banks, like for example, Chase, they have a lower interest that they can give you is because they have so many physical branches. And because they have so many physical branches and so many employees, they have a lot of more operating costs and overhead costs than a proper high yield savings account that might only have 3 branches. And they might only have them in the big cities, right? Or they might have them in a random, location in the middle of the US or in another country. So because of that, they have less overhead costs and are able to focus on the investing side of it and are able to give you a higher interest. Now, because of the resurgence of the internet, we have these companies who don't need to have a physical location at all. They just need to have customer support. Exactly. And so because of that, they have, you can open your savings account online, and they were able, and this was just a couple years ago, they were able to give you interest rates that people hadn't seen in over a decade.
Like Ally Bank and TD Bank.
Right. So like just maybe like 15 years ago, you could open an account where you could get a 5% return, 7-8% return.
Local credit unions tend to be more generous with interest rates than a big branch bank.
Right. So again, and the reason is because of how many locations and how many, like their overhead costs. It all comes down to how much they're able to afford, how much they're able to put against their investments. But it really is like, instead of having your money in a savings account in one of like these big branches, you can have a little bit of it in another account. That's what you ultimately want to look for is a high yield savings account. And you just start putting money in there. I mean, literally you can put $3 a month. It just, at this point, they don't even have a minimum. Like you can just put a little bit each month.
New investors and people with a fixed income, their best bet is to buy into stable index funds that follow the totality of the market, because that means you're automatically diversified. Let's say like you're somebody who's a Tesla fanboy. You'd say, oh, I'm going to take $1,000 or $10,000 or all the money I have in the world and I'm going to put into Tesla. You are having an anxiety attack because you're not diversified. If Tesla goes up, all your money goes up. If it goes down, all your money goes down. But if somebody is diversified in their stocks, that's one thing, because you're a diversified stock investor, but you're still having all of your money in stocks. Stocks are just one type of asset. Remember, me and Romina are growth stock investors, and we invest in multiple companies and in multiple markets. So we invest in things we believe in and in companies we know, and so on and so forth. But there are other people who invest differently and they diversify more. But when you have a little bit of money, spreading it thin isn't really a great idea when you have a little bit of money. Growing that money, saving more money, or earning more money gives you much more room to be diversified and to hedge your bets, as they say. Saying, okay, one thing might go down, but another thing will go up in its place, or it can't all go bad at once. So That's where that happens. But when you're new or you're just starting or you're very uneducated about these things, even the way I started is you do you're as conservative as possible. And that's where something like index funds, whether you use Acorns to do it passively, because that's the other thing. I want to do it passively. I don't want to make decisions. I don't want to think about this. I automate my bills. I don't even think about paying my bills anymore because I can't take the anxiety of missing one or forgetting. Right. So what I did was I automated a lot of this. And then with regard to making decisions, I went to my bank, and my bank is Bank of America, which means I invest through Merrill Lynch because they acquired that. So it's Bank of America plus Merrill. So I invest through Merrill. That's where my retirement accounts are. So for somebody who's doing retirement accounts, traditional and Roth IRAs is, but Caleb, by the way, with index funds, you're not putting all your eggs in one basket because it's automatically diversified. That's the entire point of an index fund. You're automatically diversified. Because when you buy an index fund, it's a combination usually of stocks, different stocks, real estate trust, and bonds, government-backed bonds. So you're automatically diversified. That's the entire point. And by the way, there is no circumstance in which the next day you'll go broke. The only reason people go broke in the stock market is when they gamble through what's called options trading or when they borrow money, which is called margin. But there's no point. Do you realize that there are almost no companies who have had their valuation go down to zero in the entire history of the stock market, which means it is literally, if you are investing even in single individual companies, it is literally almost impossible to lose all of your money because mathematically it's just not. And again,
you have to just, if you do, you should just not be investing.
Yeah. If you do, someone should be in charge of your life. That's sorry.
What it all comes down to, everything that Roberto just said is just diversify. It's just having a little bit of this in here, a little bit of that in there, maybe a little risk taking over here, having your safe stuff over here, having your growth stuff over here.
I was fearful of the market, and by being fearful of the market is the only reason that I'm not a multimillionaire now. Because all it requires anyone to do is become educated about things. And then it's not about,
you don't even have to be rich to start. You don't even have to.
It's not about a guarantee. It's about probability. It's all about probability. The fact that failure exists in potentially in everything that we do in life. You could literally slip in your bathtub and die. The odds are against it. Take a damn shower.
Of all of the take a damn shower.
No, for hygiene, please take a damn shower. Don't worry about slipping in the freaking bathtub. Take a damn shower, please. Because the odds are you'll live. And we'll all also thank you.
Would you slip in the shower more than
the Great Depression was a long time ago. Again, nobody Caleb, I mean, and I'm slightly picking on you. Caleb.
Oh no.
Fine. Caleb, put all your money under your mattress. Put all your money under your mattress and everything like that, and then come to my housewarming party when I celebrate being a multimillionaire or whatever off of Apple stock. I'm playing with you, and I'm not trying to flex on you, and I'm joking. This is meant as a joke.
Here's the thing. So
just put all your money under your mattress if you're scared. And I'm not trying to pressure you into anything, but I'm all right. This is what people teach people.
But here's the thing too. I do also have some money, not under my mattress, but figuratively speaking, I have some money under my mattress as well. But I do too. This is all diverse. It's diversifying. We don't know what's going to happen.
Cash is an asset. You need diversified assets. Cash is an asset. Real estate is an asset. Stocks are an asset. You have your business assets on top of your personal, which you should have liability insurance for that. You should have liability insurance for everything. Your business, your house, you should have renters or homeowners insurance.
Here's the thing. Companies just don't end up dead. That's the thing. Companies gradually die.
And you can liquidate. You can sell your stock if it goes down.
For example, I would not recommend to anybody to invest in any kind of movie theater right now.
Yeah.
That is asking to lose all of your money in the next 5 years. Unless a movie theater comes out and is innovating the movie going experience, right? But
unless they're acquired by a conglomerate.
Right. Again, this all comes down to research and being educated and following the trends and following the market and knowing what is going on in the economy. That's really all it is. Because when you use examples like the Great Depression, for example, we talked about this earlier, where so many retirements, so many of people's futures are tied to the stock market, that even if it does crash in a very horrible and catastrophic way, it has to come back again, because
or America's over and the world's
exactly
over.
It's impossible for it to just be gone forever.
Not to mention there's such thing as entropy. The laws of physics still apply.
You have to be ready. Again, as we said earlier, if you need that money, if you need access to that money today, right now, and it's all that you have, then you're not ready.
Yeah.
Then you're not ready. That's all it is. And you heard Roberto and I talking about our experiences and how we started. It was slow. There was a progression and there was a strategy to it. It's not like it's not like Roberto went in there and was like, "Ooh, $100,000 on Tesla."
I'm for eliminating debt. And I look at the interest rate. Compound interest works for you or against you, but it always works as the single most powerful force in the universe. So the thing is, if you don't pay down your debts, compound interest keeps growing and growing and growing, and the debt keeps growing and growing and growing and growing. So I'm a person who's in favor of paying down debt. Unlike Dave Ramsey, I don't believe that means translating to not having credit cards, because you need a good credit score to do a lot of things in life, and your entire future in many ways is tied to that credit score.
Sweet points, cashbacks, and rewards.
Primary example, I buy all my groceries with a cashback card, Romina, on top of couponing, because I'm still frugal AF. So I get free money because I'm going to spend the money in cash, and I have the money. I have the money to buy the groceries.
Cutting up coupons. I've gone to Roberto's house.
All the coupons are digital now. All the coupons, there's no cutting.
I've gone to Roberto's house before, and he's just sitting there. He's just sitting there with a quilt on his lap, and he's cutting up coupons from little magazines that he gets,
and going to my early bird dinners, and he
does it. There's an app for that now.
And I go to matinees and
and he goes to matinees when he goes out on dates. He only goes out on dates before noon. He doesn't accept.
Because I need the early bird special. He needs
the early bird special. Audrey, do you have any other questions? Is there any other what else? What are your plans here?
I mean, I don't know. I feel like this is a lot of
information. I feel like you have to kind of go back into it multiple times. At least I did for a couple things, there's some concepts that I grasped right away, and then other ones that I needed to go back and make sure that I understood before, I put $100 down and things like that.
I'm going to start by reading books, I think.
I think that's a great way to start. And Money Master the Game is a really great one, but again, it's like a textbook. It's going to take a while to read. It's a lot of pages.
I think if you do 2 books on audio, if you do 2 books on personal finance on audio, Money Master the Game is great on audio, and I love that.
And the audio version is amazing.
And Rich Bitch by Nicole Lapin. Those 2 on audio are locked down, and that's really almost all anybody needs, because you have a very layman, very anecdotal, very down-to-earth, folksy, Nicole Lapin walking you through this, and then you've got Tony Robbins and a lot of these anecdotes from the smartest, wealthiest people in the world.
I'm also going to add to that, because I feel like those 4, I guess, books, because 3 from you, 1 from me, are full of practical information. They're full of a lot of steps for you to take. But one book that I would recommend just for mindset is You Are a Badass at Making Money.
Oh, I love that one so much.
That's a really great book just for mindset. It's not one that's going to help you invest. You Are a Badass at Making Money. And that one is purely mindset. That is just to get you out of the mindset of
scarcity and fear and what I can't do. I tell people, look, if you could find $3 extra a day, you'd have your first $1,000 saved up. And if you found $3 extra a day, whether you stop spending it or whether you earn it, that $1,000 is $1,000 in savings that 60% of Americans don't have. So you'd beat 60% of Americans on $3 a day of savings to get your first $1,000 in a year. And this is the most practical method I know to get to $1,000 extra in a year, is to either make or save an extra $3 a day. My best version of it is finding a $20 side hustle that takes you less than an hour. $20 side hustle every day that takes you less than an hour is my methodology that I've always used especially when I was broke, because it was what worked for me. And then I had extra money, and if I need to spend a little, I could have a little. If I wanted to save, I had a place to pull from. I understand. And someone's saying is like, Caleb, you should assume that if you work for a company, they're going to sell whatever your value is for 10 to 100 times. And you should assume that nobody will keep you employed long enough to give you a pension. You should assume that pensions will never be the promises made to our parents and grandparents. You should assume all of those are now in void. You should assume that Social Security will be dead and empty and will never come for you. You should assume that you will not be helped in any way beyond a wage by an employer. And you should assume that you will be never helped in any way by the government, no matter what their promises is or what happens. And I hope that good happens. I really do. But you should make the assumption that no one is coming to save you in terms of handing you anything. And you should assume that no promises in terms of a pension, a retirement, or even gainful employment are on the table. You should assume that you are alone. Like, that sounds really negative and cynical.
No, it totally makes sense. I mean, the first few years of adulthood, I definitely felt like I was very complacent, and I felt like things would just happen to me because I didn't understand that I had to put in extra effort. I thought that things would just happen for me, and that eventually I would get what I deserved, right? And but things started to go in the opposite direction, and that's when things started to get scary, and that's when I realized that I had to do something about it. And that's also when I realized that nobody was going to help me, and that I had to do it myself. And it was a very difficult thing. Caleb also mentioned in the chat, he was talking about single mothers who can't save $3 a day.
My mom was a single mom, and she worked hard, and she got out of a relationship and marriage that wasn't good for her and wasn't healthy for anybody involved, including us kids. And she had 4 kids. She didn't do anything really wrong in any meaningful way. And at best, she made miscalculations that should not have resulted in harsher realities than they did at best. And in many cases wouldn't have if things had even been slightly different, or if the world had been slightly more equitable. And my point is, she ended up in a lot of bad economic hardship and times. But fortunately, she taught everything she knew to her children as much as they could learn. But she taught everything she knew to her oldest child, her son, her apprentice. And he took that knowledge and added to it and worked equally hard, if not unreasonably hard, and struggled and was broke and poor for many, many years, and not through any gifts of luck other than bad luck, not through any great networking contacts because he lived in a small ass podunk town in the middle of bungfuck Egypt, and not by any change in the socioeconomic status of the country, not by the Obama administration or the Bush administration being generous in any meaningful way. He managed to make something of himself by understanding a very simple principle. Money is a tool, not a goal, and money is exchanged for value, and people only pay for the perceived value of something and not a dime more. And what he learned to do was make himself useful to people who had disposable income because no one else would. Because the thing that nobody does and that nobody understands is that the rich are not the enemy, they are a resource. And by that I mean, if you want to separate the rich for their money, do you know what's a lot easier? And I'm not saying, oh, maybe we shouldn't raise taxes on some people or something like that. I'm not saying that. But I know it's slow as hell, and it didn't happen in my lifetime, and it didn't happen and save my poor, hardworking single mother, and it didn't help me, and it didn't come in my lifetime. So you should probably make the reasonable assumption it's not going to happen in your lifetime. You should make the assumption that the world is not going to change in a way that's going to become better for you, unless I decide to take over everything and rule the world. Then things probably aren't going to become any better for you, because I will be a benevolent tyrant. Now, that being said.
Well, the thing is that if the world does change for the better and does benefit you,
it'll be too matter.
Slow. It doesn't. But here's the thing: even if it does, it doesn't matter because you're already ready. So you're just going to get double, right?
Yeah. Even if it does, there will be no great equality. There will be no great equality. There will be no great distribution of wealth. Because I will tell you a secret.
At least not in our lifetime.
At least not in our lifetime. But here's the thing. Romina, even if there was, it would not matter. And I will tell you why. It will not matter. And I will tell you why.
Yeah.
Because if you could not earn $100,000 on your own, if you could not earn $100,000 on your own, and it was gifted to you tomorrow, no matter how long it takes, you would just spend it. And that money would find its way into the hands of the people who could create the most value for you. And then those people would spend it on who would create the most value for them, which means no matter how much you think taxing the rich or fleecing the rich is a good idea, and maybe it is for all I know, because it'll take care of your immediate problems, you will never, even if you can solve poverty can be solved. You will never solve income inequality and wealth inequality, because the reality is, unless people are capable of creating equal value, which they are not, which require them to be equally skilled and equally intelligent and equally creative and equally talented, unless you did that, it won't matter, because that money you have will not be held. It will be spent or it will be invested, which means that in some way, shape, or form, it will circulate right back up to people who can do things for you or create things that you can't create for yourself. You will spend it on somebody, and it most likely, yes, some of it will be your local small business, but they will spend it with a big business that supplies them the thing they need to stay in business. And that business will buy it on something that they need to stay in business. And lo and behold, it will end up in the hands of the people who created the largest singular amount of value by solving the biggest problems that there are. And you can take offense to that, but what you're taking offense to is goddamn math. It is math. It is math, because the reality is every single one of us is going to put money in the coffers of Walmart, which is going to put money in the coffers of the trucks that do the distribution, which is going to put money in the coffers of OPEC when they buy the gasoline, which is also going to put money in the Microsofts and Amazons when they have the servers that do the hosting for the machines that do the payroll. And then that money is going to money will circulate at the top more than it will from the bottom. It will always move and flow upward to the people that create the most value. And that is literally.
And it's just going to make the bottom a little bit more tolerable.
That's all that's going to happen. And the thing is, if that's all that does happen, I'm okay with the bottom being more tolerable. I want that for people. Yeah. I'm a vocal proponent of things like UBI backed via VAT, which a lot of people disagree with me on. I'm a proponent of literally free vocational training and improved education and some form of universal health care to help people on the bottom. But what bothers me is that people think that literally you could do all of that and somehow they're going to close the gap between people who also would have that and also still be smarter than them. And it won't happen, because you can't catch up to people who are smarter than you.
Roberto, hold on. Wait, relax. Shh, deep breath in. All right. So the thing about your mom is that maybe she didn't have a lot of money to invest or to save up, right? Let's say
but she was smart with money. She just didn't have enough of it, which I understand people's issue.
Wait, but hold on.
I lived it.
But she did one of the most important things that she could do for her future, which was invest in you guys.
Bingo. She invested everything into us kids and in making us as educated as possible. My sister, she got accepted to Harvard. She didn't get to go because we couldn't, even with all the financial aid and everything that we did, we couldn't get the money that she would need to, like, even with her scholarship, she wasn't getting a full ride. So my sister got accepted to Harvard on her merits, but she still couldn't afford to go no matter what student aid and what grants and scholarships she got. My sister still couldn't afford to go to Harvard because we were poor. So like, but she had the opportunity. So the thing is, opportunity isn't always the issue if you don't have any way to capitalize on it. So a lot of people mistake that, and they put things down to luck, but it's not down to luck. And the thing is, there are other choices that, like, if I'd made differently, or maybe my mom had made differently, or other things, we would have had the ability to have the extra $5,000 that we needed to be able to give her the shot at maximizing on that and going to the Ivies. But she still got an education. She still got a bachelor's degree in psychology. Some things happened with her health that she hasn't been able to make the most out of that because she has a chronic illness. And so, that was one method. Another method was my grandmother went into debt to buy a computer for us, and I became a computer nerd, and I did everything I could to elevate the family. I did everything and Caleb, I'm not trying to come at you if you feel that way, and I'm sorry if it bothers you or something like that, but it's like, the negativity and the fear that I like see in what you're saying, and the fact that you're literally trying to contradict everything I say at every turn, is you are reminding me of the things that were in my head that kept me struggling and kept me broke and kept me poor. And that's maybe why, if I'm coming at you sideways, if you think I'm coming at you sideways, it might be that. But you are reminding me of poor Roberto and poor Roberto's poor mentality.
It might also be because I feel like it's kind of two of us, right, that are kind of ganging up on him, but we're not really. I mean, he just is very active in the chat, and
I love Caleb,
reasons to interact with him. But I mean, I feel like we're saying these things in order to help Caleb directly because he's giving very specific examples. And I don't know about Roberto, but in my instance, it comes from a place of frustration, because I have a desire to want to explain and to help. And it's a little bit frustrating having to deal with that kind of mindset of I can't
help anybody who believes that they will always be poor and that they need everything in the world to change for them, because I've already lived through this, and the world doesn't get better a lot of the time. And also because
we're coming into a game where we've already lost, where the host of the game has already decided that we've lost. And so because of that, it makes it very difficult for us to give any kind of
encouragement or advice or anything, like, because like, if you just believe that, if you believe the things that I'm hearing, you will literally be poor for the rest of your life, because nothing ventured, nothing gained. And even if you bring up every type of example of other people's bad situations that you bring up, I've already helped people in those situations through information and knowledge. I've seen other people I didn't help elevate themselves out of those situations by learning the things that I'm talking about. A lot of them are more successful than me. Like a lot of them, like, and again, I'm not saying you did something wrong. And you're saying you're gone, you're out. Like, Caleb, I wish you well and happy holidays. And I'm sorry if you're hurt or offended and everything like that. It's not about what you did. It's like, you are literally, you were in the chat contradicting and saying things and like giving a lot of straw man arguments to the thing of why the things we're saying are not practical or this or that, when we literally know that they are, and we've lived it. And you'll find that every successful person repeats the same things because they're true, in the same way that if somebody was going to tell you how to get into shape, they will tell you, eat nutrition, do cardio, lift weights, drink water, rest up, don't work out every day, take rest, take breaks. They would tell you the same things, and everyone could be fit, but most people don't have the education to be fit, and they don't have the discipline to be fit. And the thing is, financial fitness is exactly the same thing. And again, if somebody's going to be emotional about something that is mathematical, and then they're going to say, well, I'm offended or I'm hurt, or what if I say that you're wrong?
See, I'm very good with the financial discipline, but the physical discipline is something that I still struggle.
I still struggle a little bit. I was better at when I was younger, but I'm like,
and I have the time, but the thing is that I'd rather exercise my mind. I would rather spend 3 hours reading than 20 minutes doing exercise. And that's something that's very difficult for me. So
Audrey's better at that than both of us.
I walk a lot. I walk a lot, and I kind of but I do my audiobooks while I'm doing that. So
Audrey
it's like,
would whip us into shape. She's a runner like Casey.
Are we gonna do a training session with Audrey? She's gonna.
If we go to California, for like a month, Audrey will have us in marathon shape. I swear to God.
Oh man,
she'll have us out there. Our lungs will be like crying on.
She's gonna be she's gonna be following us with a whistle. She's
yeah. Yeah, it's like, yeah. And again, I'm just like, Caleb, I'm sorry if we like hurt your feelings or if like you can't apply this to your situation, but I do know that it's a mentality thing and not everyone's ready to hear it. We're trying to help.
You can start off with, you can start off by listening to You're a Badass at Making Money.
Yeah.
And
like, but I also, I do know that I get impatient and frustrated with people with a scarcity mentality because I feel like, okay, why bother? If you're going to just debate, what about this? What about this? What about this? And it's all the worst case scenario and fear instead of the upside. It'd literally be like me saying, hey, you should go ask that person out. Hey, she was flirting with you or he was flirting with you. Hey, should I? And then you keep giving me every reason why you should sit there and stay safe on the wall. It's like, I'm going to throw my hands up and then I'm just going to go and ask them out myself. Like, it's like that's, and then go, wow, see, all that beautiful person was doing was waiting for someone to have the guts to go up and to actually take an interest in them and to compliment them and to hear them and to ask them questions and to flatter them sincerely. And literally, they were more interested in you than me, but I actually did something about it and you didn't. Audrey. And I became more interesting. Like that. Audrey. It happens all the time. Hell, my friends used to do it to me. All of this?
I mean, I think this has been really helpful to like learn about. I mean, obviously, like for people in the chat, we're not professionals.
No.
This is just a conversation. So take what you want from this, but do your own research.
We told you at the beginning, we did a disclaimer at the beginning. This is for entertainment purposes only. Don't take advice from jackholes on the internet. Do go hire a CPA or talk to a financial advisor at your bank, which those are free, and they'll give you some basic advice. And almost none of it will contradict what we said. And you can literally read books like we've recommended. Those people are people who literally went from broke and turning their lives around. I'm not saying it'll be easy. We're saying it will be worth it to you. And we're talking from our own lived experiences and everything like that. None of y'all knew me back when I was broke, Roberto. None of y'all knew me when I was broke, Roberto. Some of you have been around the community and saw me. Some of you have been around the community and saw me come up, though. Some of you saw the years that I was working on like a $450 laptop. Some of you remember the old days when my camera's autofocus would get super, super blurry back in the old days because I was using a BS camera. I didn't even have a flip screen. So, like,
guys, if
some of you know,
if you are listening to this episode, and you do manage to get your credit score to 800 and above, and you manage to become a millionaire, then please don't forget to leave us a 5-star review. Remember where your roots. Remember your roots.
Remember where you came from.
Remember where you came from. You started at the bottom, and then you listened to NARP.
I doubt that would be what would do it, but
hey, you know what? You never know, and because of that, I want to plant the seed. I want to plant the seeds that are gonna help us rank up in the iTunes store because that's really all that matters.
I hear you. That's what matters. That's what matters.
Reducing the gap, the poverty gap, eliminating world hunger. These are very small things in comparison to the 5-star review. This is sarcasm, by the way, for those of you who have trouble with jokes.
That's hilarious. Oh yeah, there's some people who like struggle with nuance and everything is literal. And again, like this is all in good fun and it's also meant to be. And I know like finances and stuff like that isn't always fun for people. It's not always fun to talk about. I don't like talking about money. A lot of people think I like talking about money and I like bragging about it. You guys both know that I actually am very uncomfortable talking about money because that's like when you're raised, especially as like a minority or an immigrant, like you really, really don't want to talk about money. Like you're raised to think it's shameful, no matter, even if you're making money, it's shameful because now you're making people feel bad. And then if you aren't making money, it's shameful because you're poor. So like there's no way around it. But the fact that there are no honest conversations about money is what makes people struggle.
Right. And I love actually having these honest conversations with you guys and being able to have a little bit of more context because I feel like most of when I talk about money is through text. is through either my blog or it's written content, and it goes on Twitter. I've made a few videos regarding finance, but I feel like most of it has been through text. And because of that, a lot of the tone and the context gets lost.
Yeah.
And because of that, I get a lot of backlash, particularly from people who are kind of anti-establishment and anti-money and all this stuff.
Yeah. The same thing happens to me, and it's like the most negativity I get in Twitter.
Yeah.
It's from the people who probably benefit the most from my help.
Yeah, exactly. And I get stuff like that all of the time, constantly. And that's why whenever I encounter it, it's a little bit frustrating, because it's kind of like handing someone a plate of food who's hungry and saying, here's the food.
But they're nitpicking
and they're coming up with reasons for why to not eat the food.
Yeah.
And so it just gets a little bit frustrating, because you're literally handing them.
I was so proud. Like, I'm not a millionaire. I was so proud of my friend who, opened up to me and told me about his situation with being homeless. And like, it's something he talks about a little bit openly now, but he was ashamed of it for a very long time. But he's so happy, and he's trying to motivate people in his own community. He's not a finance YouTuber. He's an entertainer, but he's trying to motivate people in his community and say, guys, I used to be homeless, and now I just became, like, my net worth is $1 million. I'm technically a millionaire, and I do the thing that I love every day. And all I do is talk about my favorite thing on the internet. And that's what he does for a living now. And he's someone who was homeless, and he wants to say, if he could do it, then you can do it. It's not going to be easy, but you have to make choices. You have to make sacrifices. There's a Star Wars YouTuber I watch who, he wasn't quite homeless, but he says the same thing. He was making his videos on a broken iPhone. He didn't have to be lucky. And he's the biggest Star Wars YouTuber now, and he's beloved by the community, universally even. And he's, I think, at like 2 million subscribers now, and he's like killing it. And he's very giving and generous with the community. And he started on a broken iPhone. Mr. Beast started on a broken iPhone. Like, there are people, and they're not overnight successes. There are people who make sacrifices. They do the live like a monk thing for 3 or 5 or 8 years, and they go through a lot, but they learn and they evolve and they grow and they adapt. And usually the world never shifts in a way that would favor them beyond maybe advancements in technology. If the world's going to favor you, it's going to be because technology makes something you want to do more accessible, and it makes it much more scalable. The things that I wanted to do, Romina, like the technology of my time when I was Audrey's age didn't allow for me to be successful, even if I had some money to throw at it. The technology of my time was so limiting. And you remember what it was like in the 2000s. It was so, in the early 2000s and in the late 90s, it was so limiting that my abilities would never have scaled anyway, even under the best of circumstances. My only hope would have been to maybe being an early adopter to something, or becoming a programmer and developer and building an app before anybody, but I didn't do that. Those were choices also. I wanted to pursue my artistic abilities more than my technical abilities back then. Now it's kind of more balanced, or even the opposite. Like, but the point I'm having is, I had to wait for technology to make my talent scalable. And by the time it did, I was ready. And that was because I made choices. Other kids went and spent more time outside. Other teenagers, they spent more time chasing girls or doing stuff. And I lived in the internet, and I built the skills of a video editor 10 years before YouTube. Like, well, maybe not 10 years, like maybe 6 years. No, maybe it was 10. Like 5 or 6 years before YouTube existed for sure, because I was already an adult. Like, before YouTube existed, before I graduated high school, I was a video editor who had spent thousands of hours in video editing. I was someone who spent thousands of hours in Photoshop before I graduated high school, because I made choices that other people didn't. I only cared at a certain point about my small group of friends, the technology, and the track team, and that was pretty much it for a very long time in my life. And it meant that I put a lot of hours into building skills. It was like 5 of them. I was one of the first kids to start selling like Yu-Gi-Oh and Pokemon cards and Magic cards on eBay. So I was early to e-commerce by flipping trading cards.
Man, I spent an hour and a half 3 weeks ago going through all of my Pokemon cards just to see if
there was bank.
There was no bank. I think maybe the most expensive card I had was like $20. And I was like, the time that it will take me to list this, I can make 3 times as much.
Yeah.
I would rather keep the card and pull it out at parties. You know what I'm saying? Like there's no point in that. Now, if it had been maybe like $100 or like $200,
I have so many Yu-Gi-Oh cards that actually might be worth it. I have so many Yu-Gi-Oh cards that's probably worth it.
I just sat down and I did. I was like, I put it on my calendar and I was like, this is it. This is my time to do this. And I looked it up and I went through every single card that I had. Nothing special. Nothing that was worth the time that I would need to put in for any of that.
That's crazy. But yeah, before 18 though, here's the skills that I had that would be the skills that would make money that I could invest in myself. Before 18, e-commerce, graphic design, web design through HTML coding, video editing, and photography. I had spent hundreds, if not thousands of hours across 5 skills by the time I was 18 years old that all have a high income or a commercial value to them. But the problem was in 2002, most of those things weren't taken that seriously, or you need to put a lot more money behind them to be taken seriously. If you don't have certain camera gear, you can be a photographer. I had an eye for composition, an eye for color, an eye for lighting, but I didn't have the right gear, couldn't afford it, was broke. So there was like, I could only make a little bit of money on the weekends with photography, not a lot. And I was in a small town, so no scale, right? Photoshop and graphic design, not taken seriously as a profession or a career. And most people want it for like print design and they were being cheap back then. I believe the future was digital. My professors didn't agree. I was right. They were wrong, but it took years for me to be right. Video editing. If you don't have a high-end computer, which I did not, no way to scale that, no real future there. So that was out. The web design was the thing that was theoretically scalable at the time. It took in 2002, though, it wasn't even considered a legitimate degree. E-commerce, technically scalable but not really to what we believe today at the time. And again, at the time, it took more time than was effective to flip stuff. It wasn't like how we have retail arbitrage today. So, and I didn't have the money to invest in anything really. Besides hobby level. So again, the only real marketable, scalable skill I had in the early 2000s was a combination of web and graphic design. And then the other stuff I could make a little bit of money from maybe on the weekends if I was lucky. But I got there in my teens with my free time by making choices, and choices matter. And so that was the ability to earn extra money and invest in myself. Best investment to be made. Later, though, because I invested in myself and because those things were future proof in a world where labor kept shrinking and shrinking and shrinking and being worth less and less and less and all that stuff, and jobs could go away and more volatile, I had specialized skills that made me valuable to wealthier people. I had specialized skills. That's the difference between someone who works at a factory, like what Caleb was saying and everything like that. If you work at a factory, you don't have a specialized skill. So you can never make enough money if you don't have a specialized skill. That will always be true. The difference between people who earn the most money and earn the least money is specialization and competition.
Marilyn Monroe was working at a factory, and her specialization was looking beautiful in front of a camera. So you got to just find what you're good at. Exactly.
And also, again, what the demand is for.
It sounds like a joke, but I'm serious. I mean, she could have been a factory worker for the rest of her life, but she was good at being in front of a camera. And because of that, she went on to earn more money. And
she marketed herself, which is another important skill. So communication
hold on,
skills.
Before we keep talking about that, but before all that, I want to kind of chime in with Audrey here for a second, because she's being really quiet and she only chimes in like every 20 minutes or so. And we're already getting close to the 2-hour mark here. So I think we should start wrapping up soon. And I feel like Audrey, if you have any last words before we yank that mistletoe off of your head.
He's been staring at this for 2 hours.
I keep looking at like my vision. I feel like my eyes are cross-eyed right now.
Well, me, I just keep looking at the chat. Partly
Audrey,
to see who we've offended now. Like,
I mean,
give some input.
I mean, I think I need to, before I can give more input on the financial stuff, I need to read more books. But what Roberto was just talking about with the skills and stuff. I mean, I completely agree on that. That's why I've been spending so much time doing video editing and photos.
That's stuff. Where you're like a kindred
You've been improving
spirit.
Your skill.
Yes.
You're a kindred spirit, Audrey. I've always felt that way about you, like, because you've always worked really hard at improving your creative skills and your ability to make yourself worthwhile as a creative professional and make yourself valuable to people who have the money to put behind that, putting that creativity to work for them. You know, whether it's an individual, a company, a brand, you know, whether it's as a creator of your own content, or whether it's as a creative professional helping deliver something to a client, you've always tried to better yourself and work on your skills. And again, you know, the thing that you want to do is something that 99% of people can't do or don't pursue, which will always make you disproportionately valuable. It won't shock me that if you have a skill that 99% of people don't have and don't pursue, that you end up with a life that 99% of people don't have.
Well, I think the most important thing about Audrey too is not just her ability to build up her skills, but also her willingness to do so.
Yeah,
because she's very open-minded towards taking in new information, but she's also very practical with how she applies that information, and she applies the information that she feels is right to her, right? So she's not just blindly following us either, because I know that Roberto and I have definitely told her to do some things and she has not done those things.
Or it's not always right away. I mean, it's not always right away, because sometimes it'll be 6 months later. Same thing. There are friends of mine. There are larger content creators that I talk to.
I'm not saying that as a bad thing. I'm saying that as a good thing.
Okay, good. Yeah.
Right? Because she's not just blindly listening to us. I don't want the audience to think that Audrey is just like our little...
No, we wouldn't lead her astray. And she's not a sheep.
I wouldn't let them do that.
No, she's an independent.
Yeah, she's gonna whack us on the head with her missile.
Audrey is a strong, thoughtful, intelligent, independent woman who also has the wisdom to seek the counsel of her elders.
She's gonna.
Sounds like a quest in a video game or something.
I mean, kind of. And with that thing swinging around on your head, I can't handle it.
I'm genuinely out here.
Every time.
I'm genuinely out here though, like trying to give people, speaking of video games, I'm trying to help people have a better tutorial, because I feel like the tutorial society gives for life is trash. The tutorial for the MMORPG that is our lives is like really trash. And I'm like trying to be out here as like, in my purple epic raid gear, coming back down to like the starter village, like, hey y'all, this is the real game. Like, this is the meta game. This is the meta game. This is the stuff they don't tell you. This is the things that, like, these are the hacks. These are the things. This is how you shorten that grind. This is how you get to be like a level. This is how you become a level 90 Death Knight here. This is how you become a level 90 Death Knight, with epic raid gear and like all this like gil. Like, this is how you do it. Like,
speaking of life hacks, guys, everybody should get 8 hours of sleep every night. And I'm one of those people who needs to get 8 hours of sleep every night.
Okay, that's a subtle hint, but like, practical advice is this thing. If you have a job right now and it doesn't pay you well, don't wait on the government to intervene. You need to find a skill that pays very well at something you won't despise. And while you're working your job, you need to make a choice. And your choice needs to be that in your free time, you will build and develop a specialized skill that people will pay a lot of money for, whether through a company or independently. Because what will happen is you can lose a job, but you won't lose a skill or a trade. Okay? You can lose a job, but not a skill, not a trade, not a vocation. They can't take that from you, because you can still serve. And you can still serve as long as you have the ability. But if all you have is a job and you're non-specialized, you can be easily replaced and disposed of and cast aside. But if you are a specialist at a skill that also has a high level of difficulty, but you've made the sacrifices to become very good at that skill, then there is a demand and a need for you, and there are very few people to fill it. So all of a sudden, if you work at a factory, if you work at an Amazon warehouse, if you work in retail, no one needs any real training to be able to do that job as well as you do it within a week. Sorry to say. Within a week, anybody can do your damn job. So you need to specialize in something and raise the standards you have. You can start small, use free courses on Skillshare, go to community college, do whatever it takes, maybe even become an apprentice of somebody who's got the skills, but learn a skill or a trade or a vocation, and then use that to put yourself in a position where you either leave your job for a better job would be the first step I take, rather than be independent, because you need resources to be independent, to be responsible for yourself. So your best bet is to move up the ladder and get a better paying job. This is what I did. I left the mall and I went to a company. I left the mall and I left behind an hourly wage and went to a yearly salary. And so that was one of my first steps. I went from that, eventually over a period of time, using my job's money to buy the same resources that my job provided me with, so that if they fired me or if I quit, I'd have the same tools to do that same job without the company giving me anything. So I went out and I bought equal or better tools with my extra money, whether I had to save, scrimp, whatever, I did that. And then I was able to go my own way. And I got out of debt.
Wait, Audrey, I have something fun. So, okay. Audrey, why don't you tell us what the key takeaways of this episode were for you?
Ooh.
Okay.
Key takeaways. Don't do a whole recap.
Okay, main takeaways. The difference between index funds and directly investing in companies.
Ding.
Nice.
I feel like there's so much. Hold on, I'm trying to go back. What were we talking about near the beginning? There's the saving account stuff. But I asked direct questions on these. What else was helpful? I think it was just helpful to learn more about how the entire system works. So it can get
well, you got a couple books to get you started too.
Yeah. Yeah, I'm definitely good. I'm dead serious. I have like Audible points or whatever.
Yeah. Called. Well, so a lot of those, like I'm a badass at making money is a great audiobook too, because it's read by the author. It's really great. All of those audiobooks I think are engaging enough to listen to.
When you don't have money to start investing, invest your time into building a specialized skill or multiple specialized skills that will help you to earn the money you need to invest in yourself. And then after you invest in yourself and you can grow even more, you have money to invest in the market that you can risk that doesn't affect your day-to-day living situation. So you don't have to be fearful about, well, what if this goes wrong or this goes wrong? Because the thing is, as long as you hold your breath, the market goes back up. So that's number one. And number two, as long as you're diversified and you're not all in on something, and as long as you educate yourself before you invest, then things tend to be okay. Things tend to be okay. And greedy people are the only people who lose. People who are greedy are the people who lose. So don't be greedy. Be smart. Don't risk anything that you can't afford to lose.
I'm going to put the books as well in the description after this video is uploaded. So if you guys are listening back, check out the description of
I'll let you use
video.
your affiliate links or Audrey's affiliate links, Romina.
Yeah, I'll put my affiliate links for the books, and then if you can remind me what your Audible thing is, because I think you give people a better deal than my Audible one does.
No, we have the same deal. I think we have the same deal.
Oh, really?
Yeah.
Okay. Well, we'll verify that, and then we'll check and put whatever's the best one for the listeners in the description. But I think that we should start wrapping up, just because we've been going for almost 2 hours.
Yeah, it's late and
there's a lot of information. So if you want to think about if you want to think about an outro, I feel like Roberto's pretty much summed up everything that I've that I would say.
I have an outro. Believe it or not, I actually
I don't believe it.
Yeah, I have an outro, but something I want to say, and just thoughtfully, is that I don't believe in the concept of survivorship bias, because I think it's absurd that you would preface the advice of people that are still struggling over people who overcame a struggle, and that you would invalidate the advice of somebody who made it out of the circumstances or worse circumstances than you because they're not in the struggle, and decide that that makes them hashtag unrelatable. They don't need to be relatable. They need to be right. And they are, because if they made it out, they hold information that you don't have. And the problem is, we romanticize our struggle as an identity. And as much as we resent the identity of struggling, of being broke and being poor, because it's the only identity we have, and I'm speaking from my past life experience here, we cling to it with every ounce we have when the beliefs of that identity are challenged. And when that happens, I do come at people aggressively because I'm trying to shake them, because I'm trying to wake them up. I know it sounds tone deaf. I know it sounds arrogant. I know it sounds condescending. And as much as you might like me to sound much more politically correct in that regard, it is more healthy and more important for you that I be right. It is much more important for you that I do everything in my power to wake you up and to shake you out of your limiting beliefs that will doom you much more than your circumstances. Because the thing is, if you have limiting beliefs, changing your circumstances won't save you. It will be a band-aid. It will not save you. You are doomed. If you have a doomed philosophy in life, you are doomed, and no amount of saving you from your circumstances can save you from the demons in your own head, unless you choose to evict them. Unless you choose to evict the demons in your head, there's no amount of changing your circumstances that can ever save you. And I know that from personal life experience. And it's also the real truthful antidote of every person that we've ever loved and has been beloved by millions of people that is no longer with us, despite all the love and all the praise and all the money in the world. It wasn't enough. So you have to understand that you have to overcome those things. And if you can't overcome those beliefs, then it's a bigger issue than money alone. And so when I say these things to you, it's from the deepest place of kindness and the deepest place of having lived through and survived that hurt. And it's not survivorship bias, because that is a BS piece of psychobabble that people came up with to vindicate victimhood. And it's not something that is part of the mentality that is going to make you a champion of change in your own life. And you are the champion of change in your own life, not me, not Barack Obama, not Donald J. Trump, nobody else. You are the champion of change and the agent of change in your life that you're looking for. You just have to actually believe in yourself, respect yourself, and treat yourself like somebody that you actually love and give a damn about and are responsible for. And if you do that, then your life will improve. If you don't do that, then it will continue to have obstacles and hardships that will feel insurmountable. And to that effect, what you really need to do, if you take nothing else away from all of this today, is you need to take a hard look at the story that you are telling yourself and the things you have chosen to believe. And you need to understand that your struggles aren't special. You are. Your struggles aren't special. Someone has overcome those things. Your struggles aren't special. You are. And you need to put yourself in a position to deliver on the value of the thing that makes you special, and give that thing to as many people as possible, and to invest in that thing that makes you special, and to grow that God-given gift, that talent, that ability that you have inside of you, whatever it is. And that's your responsibility. And you owe it to yourself and you owe it to the world to make the most of that thing that nobody else has. And if you can take some time and you can do that, and you can be patient, you can deliver on the promise of your potential, and you can make the world slightly better than you found it. You don't have to change everything. You don't have to save everybody, but you will probably save yourself from a lot of grief and a lot of heartache if you stop thinking about everything that you can't do, and you focus all of your energy and all of your attention on what you can do. and turn what you can do into what you will do each and every single day. And so that's my thoughts, and that's kind of where I want to leave it, unless you guys have anything else that you want to add, because that's my message, and that's everything I'm talking about.
No,
same.
That was a great ending, I think. Good hype. Ow.
All right.
I don't have anything else to add.
Do we have an outro, or should I do a...
Yeah, I have an outro.
Okay.
Audrey's ready to jump in.
Oh, do you? Do you want to do the outro, Audrey? Because I do have one. But...
No. I was gonna not distract. What's the word?
Delay.
Stall.
Yeah.
Okay.
She's gonna stall. Yeah.
All right.
No.
Thank you for listening to the No Assembly Required podcast holiday edition. I would say that no audience members were harmed in the filming of this episode, but that may or may not be true. Anyway, we do enjoy those of you who enjoy the program, and we thank you for reviewing it on all of the available apps, which don't include Spotify, because they won't do their damn job. They're too busy trying to put out fires caused by Joe Rogan. But no such fires exist on the No Assembly Required pod, so please tune in for another holiday special the following Wednesday. It usually is Thursday, but it's Christmas time is here, so that will be it. This is your trio of hosts, starting off with Audrey Chestnuts Roasting Ember, Romina the Santa Corn, and of course the Grinch who stole Christmas, New Year's, and Three Kings Day, Roberto Blake. Thank you for listening to the No Assembly Required podcast. #GrinchBerto. Nop.